Welcome to The Explainer. Today we're diving into something absolutely crucial for the foundational bedrock of our financial system, mortgage finance. We're going to explore a strategic framework, drawn directly from the latest SASB standards, on exactly how mortgage finance entities need to integrate climate change and environmental risks right into their core operations. So if you're an executive or risk manager in this space, this explainer is basically your blueprint.
Think about it for a second. Is your mortgage portfolio truly weatherproof? Traditionally, we've always looked at real estate collateral as incredibly safe, right? It's physical, it's permanent, literal terra firma. But what happens when that terra firma is suddenly under 3 feet of water, or sitting right in the path of a Category 5 hurricane? The modern reality of climate change is forcing the entire industry to completely rethink what safe collateral actually means.
So here's our roadmap for today. We'll start with how extreme weather intersects with mortgage finance, move on to the SASB disclosure framework, and then quantify flood zone risks. After that, we'll tackle projecting catastrophe losses and wrap up with how to adapt your underwriting and origination processes. Let's get right into it.
All right, Section 1, Extreme Weather Meets Mortgage Finance.
Look, the SASB standard lays out a pretty stark reality here. When the frequency of extreme weather events ticks up, we see a direct, measurable hit to the mortgage industry. And we aren't just talking about a bit of property damage. Hurricanes, floods, and other climate events trigger massive spikes in missed payments and outright loan defaults. At the exact same time, they decrease the value of the underlying assets securing those loans. It's basically a 1-2 punch to a lender's balance sheet.
Moving on to Section 2, the SASB Disclosure Framework.
You know, the SASB standards, which are now under the authoritative stewardship of the SICS, by the way, really give us the core framework for making this shift. Investors are practically demanding to know how companies are measuring and managing long-term portfolio value against these environmental threats. The industry standard requires tracking very specific quantitative metrics about where loans are located and how vulnerable they actually are, because entities that incorporate these risks are, for sure, just better positioned to create long-term value.
That brings us to Section 3, Quantifying Flood Zone Risks.
Okay, so the absolute baseline of tracking this stuff, you've got to identify your existing exposure in high-risk areas. The standard actually dictates that entities disclose both the number and the total value of mortgage loans underwritten in 100-year flood zones. And just to be super clear on the definition here, a 100-year flood zone is a land area with a 1% or greater chance of flooding in any given year.
Now, what do those zones actually look like in the real world? Well, examples include coastal floodplains, river floodplains, and even low-lying areas that are subject to ponding. The real question you got to ask yourself is this: do you have the data systems in place to flag these exact geographies across your entire portfolio, no matter the country? Because honestly, tracking exactly where the water goes is literally step 1 for this kind of reporting.
All right, let's look at Section 4, Projecting Climate Catastrophe Losses.
To really get a handle on this, the standard wants you to calculate 2 absolutely critical financial metrics. First is total expected loss, which is the sum of all possible losses multiplied by the probability of them occurring. And second is loss given default, or LGD, which is exactly what it sounds like. It's the share of an asset you lose in the situation of a default. You have to disclose these metrics specifically as they relate to weather-related catastrophes.
And the standard is super precise about what actually counts as a weather-related natural catastrophe here. We're talking meteorological events like hurricanes and storms, hydrological stuff like floods, and climatological events, think heat waves, droughts, and wildfires. But here is a really important exclusion to keep in mind. It explicitly leaves out geophysical events like earthquakes or volcanic eruptions from this specific loss projection metric.
Also, you can't just roll all this up into one giant institution-wide number. No way. Both your total expected loss and your loss given default must be broken down by geographical region. This forces institutions to really pinpoint their local vulnerabilities, basically showing investors exactly where the hidden cracks in the foundation might be.
Which leads us to the big one, Section 5, Adapting Underwriting and Origination.
So, the SASB framework requires you to describe exactly how you are baking climate change and environmental risks right into your mortgage origination process, and that spans the entire transaction lifecycle between you and the borrower. From Step 1, the initial application, through Step 2, processing, all the way to Step 3, underwriting. You literally need to inject these environmental risk metrics into your decision-making at every single stage.
When you sit down to redesign those origination models, there are 2 major underwriting considerations that absolutely have to be adapted: the valuation of collateral and credit risk analysis. These are basically the twin pillars of mortgage underwriting, right? And climate change fundamentally alters both of them. Let's unpack the valuation of collateral first. Your valuation models have got to account for the inherent risks that come from a property's location. But, and this is key, it's not just about penalizing a house because it's on the coast. You also have to assess the implementation of basic adaptive measures. For example, does the property have physical reinforcements or hurricane shutters? A house with those adaptations is obviously going to hold its value way better in a storm than one without them. So you have to ask, is your valuation model sophisticated enough to actually recognize that difference?
Next is credit risk analysis, which honestly hides a massive danger. As the frequency and severity of natural disasters go up, your origination models have to assume a much higher likelihood of default. Why? Well, it comes down to uninsured or under-insured properties. Think about it. If a borrower loses their home to a massive wildfire and their insurance only covers half the replacement cost, the odds of them simply walking away from that mortgage absolutely skyrocket. Your credit risk analysis absolutely must factor in whether their insurance coverage is actually adequate against these escalating environmental threats.
Oh, and here is a really crucial nuance I want to highlight. Earlier, we noted that geophysical events, like earthquakes, were excluded from those strict mathematical loss metrics. But when we're looking at the big picture, your broader origination and underwriting policies, geophysical events absolutely can and should be included. It's vital to capture a truly holistic view of all environmental threats when deciding whether to originate a loan in the first place.
So that brings us to our final thought. If extreme weather completely reshapes the map, will your underwriting models be ready to weather the storm? Integrating climate risk into your origination process isn't just some box-ticking exercise for a SASB disclosure. It is absolutely critical for the long-term survival and profitability of your mortgage finance operations. You've got to start pricing the reality of our changing environment into every single loan. Thanks so much for joining me for the Explainer today, and I'll catch you next time.